right. So take a look at something like Ethereum to USDC, right? So one of the thing we have to realize about rebalancing is that oftentimes rebalancing is not something that we want to do. It's something that we have to do if we, for example, have a change in market outlook or we are out of range, then we want to think about actually rebalancing, right? But if you're doing it wrong, it could lock in a ton of losses. And if you guys watch the lessons, again, the range chasing strategy that a lot of yield farmers do, it actually is not profitable over time, right? Because if this green box is your range, let's say from like $4,000 to $3,000, this is what a lot of automated platforms do, like DeFi. The prices bounce around in the range, right? And when it's close to the edge, they rebalance either to the upside if it's like hitting the upper bound. And then if it's going down to lower bound, they would actually rebalance down, right? So whenever you do that, basically when you're rebalancing up like this, you're essentially buying more Ethereum at a more expensive price, right? And then when it goes down, you're basically selling Ethereum at a cheaper price. So you're buying high, selling low. And
Richard, share
yeah,
your screen if you forgot.
yeah, my bad. Sure. Thank you. Yep. And you guys see the screen?
Yeah.
Yep. All right. Thanks. But yeah, I was saying if you rebalance up and down, you're basically buying high, selling low, right? And that's a pretty basic concept to understand. You're locking in a ton of impermanent loss because if you just sat tight and the price just go up and down, comes like, and your entry was at 2,500, it goes up to 4,000, comes back down to 2,500. You basically locked in zero impermanent loss, right? Versus like a range chasing strategy, you're locking it in a ton of impermanent loss. And again, if the APR that you earn throughout the whole period is not greater than the impermanent loss, then your strategy will be losing money over time, right? And it's very hard to predict how much impermanent loss you're going to lock in because sometimes, for example, like back in July to August, the price action was pretty aggressive to the upside. So in this case, you would have missed out the pump and then locked in a ton of impermanent loss, right? That's why I don't like using tight range strategies because whatever tool you use to predict like the range, for example, Bollinger Bands is a popular one, or the ATR bands, which measures like the kind of like the volatility as well, like the average price movement of an asset. It's all backwards looking, right? So it doesn't actually tell you anything about the future. Same thing with like technical analysis in general. It shows you like, okay, the odds are like this. This is what traders see, but it's all based on historical data, right? If there's a big catalyst in the market, the price could go either up or down pretty aggressively. So that's the first thing to understand for rebalancing. If you could avoid it, then it's best to just avoid it. So in theory, you could be, for example, setting your range at 1,500 to all the way at maybe 10,000, right? And you don't really have to worry about rebalancing for quite a long time. But if the price do drop aggressive enough, you still have to kind of think about rebalancing a bit, right? Of course, with this strategy, the APR is going to be less. And maybe you don't want to be that conservative, right? Because tighter ranges can outperform if the market does move sideways long enough. So let's just say we have like a range of 2,000 to 7,000. And because you've been yield farming from maybe since like beginning of 2024, right? And then maybe you didn't even rebalance down, your range would have outperformed that wider range that I just showed you simply because the price has been like inside this pool for a long time, right? And we haven't really like broken out of this range. But if the price does break out pretty aggressively to the upside, then this tighter range would outperform. And again, we never know like which strategy would outperform until the price action actually happened, right? But in a rule of thumb is like the wider range tend to outperform tighter ranges like over a longer period of time. Let's say like 6 to 12 months or like even a few years. And if we're seeing like the price action of something like Bitcoin, the price just move up pretty aggressively, right? So it's always a good idea to like, okay, keep in mind that some of these assets could move up pretty aggressively or move down pretty aggressively. And then we also don't want to put all of our capital inside the LP simply because if you're hedging the downside, then you should be holding some stable coins, right? You're not exposed to any downside risks if you're holding stable coins separately. And then if you're hedging the upside, let's say you had a tighter range here for wrap Bitcoin and USDC, for example, to hedge the upside, you should be holding some spot Bitcoin, right? So that's another way to do it if you want to run like tighter ranges. But let's just say, for this example, you're farming from a range of $3,000 to $7,000, right? So that's a pretty reasonable bullish range if we're looking at historical Ethereum price action. Sometimes the price do swing pretty aggressively, but most of the time, like a $4,000 wide range is pretty reasonable, right? And again, if the prices just kind of like grind up slowly, then this LP would do pretty well. But let's just say the price goes to the downside, right? What do we do in that case? There's a couple things that you could do. If you don't want to rebalance, you could just sit in spot ETH and just sit tight, right? Or you could do stuff like you could stake your ETH, lend it out in different platforms that have good enough interest rate. You could use it on Pendle to be earning like fixed yield. But the idea here is you don't really want to be chasing the range down. And another way you could do it is you could expand your range. So this is what I will go over right now is the expand and squeeze strategy. Let's say you entered at around $4,000. I believe I've set this up. Yeah, $4,000 just to make the numbers simple. 4,000. And then let's just say the price crashed down pretty aggressively to $2,000. So if we are keeping track of kind of this trend line here, we would see that, okay, maybe the price, if the downward move is aggressive enough, that could be a zone of support that we could be looking at, right? So if price drops to $2,000, the drawdown will be pretty aggressive here. You would underperform holding your assets separately by 22.2%. And if you put in 100K, we want to see, okay, this is the amount of capital that we would have left, right? If the price dropped to $2,000. And for the expanding strategy, what we want to do is we want to kind of move the lower bound to near the current price, either like right above it or right at the current price. And then you also want to move the upper bound. So this is the other chart that I've set up. What we want to do in this case is, again, move the lower price to 2,000, right? The deposit price is at 2,000. Price now is at 2,000. And then upper range, let's just say you start with the max upper range, and then we can run the simulation from there, right? What we want to know is like, okay, at $2,000, we would have about $52,741 left. I want to move that over to this value deposit here. So if I paste that, this is now the rebalance LP that I would have, right? And again, when you guys rebalance, I highly recommend running through the simulation if you're doing stuff like expanding your range to make sure that you're not locking in too much impermanent loss, right? And then with a max upper range, in theory, you should be getting the best exchange rate possible from this $2,000 price onwards, right? And what I want to simulate now is let's just say the price goes back to our original entry. So $4,000. How much impermanent loss we would lock in? Even in this case, it would be, let me double check. That's correct. So 3,000 to 7,000 price deposit, 4,000. Yeah, 5,271. 741. So in this case, you will still be locking in about 3 to 4% of impermanent loss. This is why, again, I prefer wider ranges. Even with a max upper bound, if the price drop aggressive enough and you rebalance, then you're locking in about like 3 to 4% of losses, right? And this could be quite a lot depending on how long you've stayed in range. For example, if you've stayed in range for a very long time, it would have been totally fine to lock in some losses. But let's just say you just got started yield farming, right? Then of course, like it doesn't feel good or make that much sense to be locking in like 3 to 4% of losses. especially if 3 to 4% is about like 1 year of ETH staking yield, right? So, and if you believe the price is to recover, sometimes the best course of action is just to sit tight in your range, let the price do its thing, and then just wait for the price to recover, right? And of course, if the asset don't recover, then you would also lose out in that case. So
Uh,
yep.
do you mind if I ask a question, or do you want me to wait?
Now go ahead.
Okay, so in this case, right, if the price goes out of range, you will fully be converted to ETH. And if the price comes back into range, then your LP is going to be active again and you're going to be starting the conversions and collecting fees. Correct so far?
Yes, that's correct. Yeah.
So in this case, like, why? I mean, I understand by rebalancing, you will, you're going to lock in that 3 something% impermanent loss, but you will also collect fees because the price is going to take time to get back up to that point of your
Yeah.
initial price, correct? So technically, it's not like that impermanent loss, right? It's less.
Well, it depends. For example, let's say like you were yield farming with this range last year, right? Let's do the replay function. So let's say the price keeps dipping here and then it keeps going down. And then let's say it goes to $2,000, right? And then, okay, you decide like the impermanent loss locking is a decent idea. So then you locked in some, and then if the price keeps going down, it's kind of tricky to know like when to stop if you don't run the simulation. But if the price do pop in, of course, you'll start earning some more money. And then if we kind of look at, let's say the price kind of recovered from 2000 to 3000 in the span of, let's measure it here, 2000 to 3000 based on like the recent price action in the span of 60 something days, right? Of course, if you could generate a return of 3 to 4% within the last 60 something days, then you could be earning back like the amount that you locked in. But at the same time, we got to consider like, okay, you expanded your range, right? Your APR would be a bit less. Let's just call it 10% or 15% APR. So 15%, if we multiply by 2 and then divide it by 12, because it's around 60 days, right? You would have earned only about 2.5% in fees.
Oh, okay, I see.
Yeah.
Okay. So
Yeah.
it's still,
So
but it would be less than like 3 something%, right?
yeah. Yeah.
Like
Because,
it would be
yeah.
like a percent, half a percent
Yeah.
impermanent loss,
Yeah.
as
You,
opposed to,
yeah.
but like if you just didn't rebalance, oh, but then you wouldn't be in range because you didn't lower the range, right? So then, okay, I see.
Yeah, you would still be holding spot, but then you're not gonna start earning until the $3,000 mark, right? But um,
Gotcha.
it's hard to tell like, okay, what strategy is going to outperform, because if price do grind sideways for a while longer, like what we saw in like, in 2024, then of course rebalancing would probably be better. But if it kind of like dips and bounce, then a lot of time the rebalancing is not going to be too good, right? Especially if you see like last cycle, if price dipped pretty aggressively, took a few months, then bounced back pretty aggressively, then maybe rebalancing is not like ideal, right? And yeah, it's a hard call to like say what is better. But what I want to show you is actually this, like there's a max lower range that you could go down to before you actually lock in too much in front loss, right? So let's just say the price lower, instead of 2000, we adjust that to 2500. You can see back at $4,000, you would have your initial capital. So in theory, you would have locked in like no impermanent loss if you only drag the bottom range to 2500. So the lower the bottom range that you guys start off with, like you could drag down it a little bit more because you're starting from a lower point, right? But if you start it too high at, let's say $4,000, then you could only drag down so much before you start suffering too much impermanent loss. So in this case, I would personally go for the $2,500 range and then just wait for the price to recover. Because in this case, I don't want to risk like, okay, maybe I'm going to suffer a ton of losses. Unless I've already been in range for a long time earlier in the year, I'm fine with taking that loss. And then, okay, I want to earn some fees in the process, right? But yeah, ideally, you don't have to rebalance at all. But again, if you have to, then this is one of the choices you could do. And then what you guys can do is, let's say you still want to prioritize fees, right? And the price dipped below. Let's say you started earlier this year, you started with 3,000, and then prices dipped below. You decided to rebalance all the way to 2,500. And then, okay, you kind of sat tight in the range, right? And then you did go down too aggressively. And then in this case, your range would have been a max upper range already, right? So max upper range. And then what you guys can do is, instead of just staying in the wide range, since you're prioritizing APR, the wide range will be much less APR, right? What you can do is, if the price recovered back to your original entry at around $4,000, we would have recovered the close to the amount of the initial deposit, right? So zero impermanent loss. What we can do then is, like, you could set an alert at $4,000. Once the price hit 4,000 or slightly above, you could rebalance back to this initial range of 3,000 to 7,000. So this is what I call expand and squeeze. So in this case, you're just expanding your range to a theoretical max lower bound. And then when the price reach your original entry or above, you could squeeze the range back down to, again, earn more fees. And the reason why you might want to squeeze the range is, like, let's say you have a leverage setup that requires a bit more APR to kind of pay off the loan, you could do that. Or if you just expect the price to kind of like bounce here for a while, then you could do that. Or maybe you start with already a wide range from, like, let's say 3,000 to 10,000, price drops out of range. You expand to that max one-sided LP, right? But then you don't want the range to be that wide. Then you can squeeze back down to that 3,000 to 10,000, which is a pretty decently reasonable range to be yield farming with, right? But yeah, the idea here is we also want to kind of take a look here. If the price is at, let's say, 3,000, what we want to see is you'll actually suffer some impermanent loss, I believe. So let's say price is at 3,000. So on the initial LP, you would have 79,000 something dollars, right? So this is the original LP. And I recommend saving this if you guys are using this calculator to know, okay, to keep track of your original range. And then you can see at $3,000 on the expanded LP, you would still have a little bit less, right? So this is the important part. The price has to trade like near the original entry for you to be squeezing the range back. So you don't want to kind of squeeze back too early. But if we go to the upside, let's say price jumps to 5,000 on the original LP, you would have 112, right? 112K. And then for this expanded LP, you would actually have 120K. So you'd actually earn more money if the price goes up and above your entry. So you could squeeze the range back down when prices are way above your entry, but you don't want to squeeze the range back down if the prices are below your original $4,000 entry, right? If that makes sense. So any questions so far about like the expand and squeeze? If not, we could go over other concepts. Like, for example, if you want to switch strategies, when is the best time to switch a strategy? So if you guys are using a bullish range, for example, right, a bullish LP, meaning that, okay, you have much more base asset. In this case, it's ETH to USDC. You have a ton of base asset and then only a little bit of USDC, right? When is the best time to actually switch to like either a neutral LP where you would have about the equal amount of ETH and USDC, or like a bearish LP where there's a little bit of ETH on top and then a lot more USDC on the bottom? Maybe you guys could answer that question in the chat. If you're in a bullish LP, when is the best time to switch strategy? And when is actually not a good time to switch? AK is saying, if you are in a bullish LP, switch when you think you are near the top and see a reversal to the downside. Any other answers for that? Yeah, Austin is saying, assuming I'm still in range, I probably wouldn't switch unless macro condition changed a lot. So yeah, those two answers are actually correct, right? If you don't want to switch and you have a bullish outlook on the market, and you're a long-term investor anyway, you probably want to have more of a bullish bias, right? Because if you're investing in an asset, you want to actually bet on the asset increasing in price over time rather than like betting against the asset. But if you're trying to take like the swing down where like you're pretty convinced with greater than 70% chance, maybe like 80, 90% chance that the price is going to start dipping down pretty aggressively and see like a pretty meaningful retrace of maybe like 40 to 50% or more, then again, the price to switch is like at the top of the range or at an overheated price, right? Of course, it's very hard to time like the exact top, but you don't want to be switching when the prices are cheap. Because if you just think through like the different scenarios, right, from bullish to bearish, you're essentially selling your ETH for your USDC. So you could think a bit of this about like it's kind of like a swing trade. If you want to do like a swing trading strategy, then you could definitely rebalance from a bullish to a bearish LP when the prices are overheated. And maybe ETH is not something that you would want to do that with, right? But maybe some of these altcoin pairs, you want to lock in some profits, but you're still bullish on the project. Stuff like Pendle, right? If Pendle and ETH kind of swings back up pretty aggressively, and I have like a max upper range, I could be switching to like a bearish LP when the prices are near the top zone of resistance, right? So by doing that, you're selling at a better price versus if you're just doing that at the bottom of the range, right? So at the bottom of the range, we're basically doing like a range chasing strategy in that case. Yep. So that's the rebalancing part, right? You could rebalance from like bullish to bearish, and then you could do like bearish to bullish is it's a very similar setup. You guys could, for example, set like a max lower range to bid an asset. If you don't want to buy a ton of ETH at this current price, you could set the upper range of, let's say, $6,000 or $5,000, right? And then like a lower range at zero. So this is what I call like the bidding LP or a bearish LP. So if I just want purely to bid and earn some fees in the process, I want to be setting the range at zero to get the best exchange rate. So if I do that and the price upper, let's call it 5,000. And let's say you deposit it again at $4,000 and the price dips to $2,000, right? What you will notice is that you would have suffered about 13% of capital losses. But again, it could still be worth it if the APR is, let's say like 15% over like 2 years or something. It took a while for the price to drop. Then this strategy could be worth it. Or if you don't mind the price drawing down a bit, or you're not completely sure if the price is actually going to hit $2,000, right? Then you could have been running the strategy, but then, or let's say the price bottoms at 3,000, then you would have barely suffered like 3 to 4% worth of losses, right? And then what you can do from here is you could switch the range to be bullish. So let's say the price hits 2,000. This is the capital you have left. But let's just say you had some fees in the process. So you end up with 95K. Let's say you put 95 here, right? And then we want to flip bullish at $2,000. What we could do is, for example, even if you have a lower range of 1,000 and then maybe upper range of 10,000, right? Price deposit changes to $2,000. If the price recovers to $4,000, for example, then you would have made like $37,000, $38,000 just based on the price appreciation on this bullish range alone, right? So you could flip from like a bullish to bearish at any time. But yeah, the best time to do it is if the prices are overheated, you switch from bull to bear. If the prices are really cheap and you're comfortable taking on more risk, then you could switch from like a bearish LP or a betting LP to a bullish LP, right? So, and what I also want to share is you could be running this stacked LP setup. Last workshop, I called this the butterfly LP, renaming some of this, but if we call it the stacked LP, we're basically stacking a bunch of LPs together, right? And you could be flipping, for example, this bearish LP. If we see a bear market, you could be flipping that to a more neutral or a bullish LP, or even flip it to a spot back, right? So you want to know like all the options possible so that when the time comes, you have the different options to pick from, right? And again, you don't have to have this bearish LP. You could just hold spot USDC or spot stablecoins, for example. If the prices do dry down, you can add it more to the bearish LP or buy some spot or go to a neutral LP if you don't want to take that much risk, right? And then this is the other option of rebalancing. Let's say you're holding spot bags and then you want to lock in some profits. Let's say you're holding 10 ETH, for example, right? One thing that you guys can do to lock in some ETH profit is, let's say you want to sell 5 ETH, you could do a bidding LP from like 0 to 5,000, for example, like what we just used with 5 Ethereum. And then you still hold 5 Ethereum for upside exposure, right? So if ETH goes to 10,000, okay, you at least still have some ETH. But if ETH retrace by like 50% in this scenario, you can see that you would still lose some money, but you've locked in a lot of profits already, right? You would still lose money. Your total drawdown instead of 50% would be 13% for this LP. And of course, you would be earning much more fees in the process. And if we calculate the max drawdown, it's like 50 plus 13, it's about like 65, right? Or 63. And then we divide it by 2 because you're putting like 50% in spot and then 50% into like a bearish bidding LP. Your drawdown would now be only 31% on your portfolio rather than a 50% drawdown, right? Of course, your upside will be limited, but again, you're selling your ETH at like whatever price that you entered this strategy with, right? And this is another way that the hammer LP is another strategy that you guys can use if the prices are lower and you want to kind of like you're about to capitulate, right? And you're instead of selling all of your positions, you can still do this bearish LP plus some spot holding. So if the prices do keep trending down, at least you're earning some fees on like the bearish LP, right? And even if the price dries down another 50%, you're going to be better off than if you were just not rebalancing and staying out of range. So we could take a look at that with the Pendle to ETH example. So Pendle to ETH Styles did, I think he's at work right now, but let's just say his range was at around like 0.002 and then 0.0084, but let's just call it 0.00085 to make the numbers simple. Again, if I was in this scenario and I believe that the pendle price is going to recover, sometimes it's better to just be, AK, no worries. Yeah, if you guys have to go, don't worry. I'll still finish the material and then you guys could watch like the recording. Yeah, if you guys have to go, then don't worry about it. But yeah, so in this scenario, if I want to rebalance, of course, if I believe the price is going to bounce, then the best course of action is just to kind of sit tight for the next couple of weeks, see what the prices do. But if I don't believe the price is going to bounce anytime soon, I could do that expand and squeeze strategy, right? But again, there's a theoretical minimum and maximum point that we have to kind of calculate. So we could kind of run through the numbers right now. Let me see if I have a Pendle to ETH pool example. Yeah, Pendle to ETH. So it's helpful to kind of pull up 2 tabs when you guys are doing like rebalancing, just so you could kind of switch back and forth, right? Let me put the value deposit as 100. So you could think about it in percentage terms, right? So 100 here. And then what we want to see is the price upper is at 0.002, price lower 0.00085, right? So price deposit, I believe his entry was around 0.001. So this is a pretty great entry relative to like, if you look at the historical price, right? It's like at the zone of support. Of course, we never know if it's 100% going to hold. But if you enter here, if you suffer some losses, it's for sure going to be less than if you enter at a zone of resistance, right? So we could calculate that here. Let's say the price drops by another 50% to 0.005. What you're going to see is that there's about 14, wait, 1 second. 0.005. Yeah, you're going to suffer about like 50% worth of losses. So sales, we're going over like your pendle position right now. But basically, if the pendle price keeps going down, you're going to have an unrealized loss of about like 50% on your ETH, right? Let's say the price dips all the way to 0.0005. And of course, if you don't want to sell at that price point, then you don't really want to like kind of do anything too crazy, like range chase down. That's how you could be locking in a ton of losses, right? But let's see the theoretical max price upper. Let's just put it at max, right? And then price lower, let's call it 0.0005, where the price dropped to. And then price deposit is also 0.0005. Price now, let's start from 0.005, right? But then if you guys recall, the value deposit would drop to this 50.89, right? So you started with 100 ETH to make the number simple. You draw down to 50.89 ETH. I want to paste that in the rebalance position here. What I want to show you is that let's say the price go back to the original entry point here at the deposit price, right? Initial deposit, you would be locking in 7% impermanent loss, right? So that could be pretty huge. Again, especially for pools that don't generate too high of an APR. Let's say you generate like 25, 30, let's say 30% APR to recover 7%. It would take about like 1/4, like 1/4, right? Like 3 months of losses to recover that 7%. Of course, this is assuming that the panel price dropped pretty aggressively to 0.005, right? But let's say your max, you want to kind of find like your theoretical max lower bound, right? So if I bump that to 0.006, you can see now the impermanent loss you're locking in is drops to only 3.4%. And then if we go to 0.007, you're locking in 1%, and then 0.008, then you're not really locking in much, right? Because it's barely any different from your initial price point. So maybe 7.5, right? So it seems like the max point for this scenario is only at 0.0075. And this theoretical max point would also depend on your initial deposit ratio, because at the entry, it was more of a bullish range, right? So at the entry for this scenario, you're depositing like 79% pendle and then only 21% ETH. So your theoretical max lower bound, the new one, is going to be less than if you have like a 50-50 deposit. So, but yeah, if you're happy to buy pendle at this 0.001 price point, then it doesn't make sense to be selling your pendle for like any cheaper than like 0.00075 anyway, right? If you're buying at that price, why are you selling at like a lower price? Unless you believe it could go like way lower, right? Let's say like you believe it's going to drop like another 90%. So then what we want to do in that case, if you want to protect your portfolio, and maybe you're fine with locking in some losses, you want to do this hammer LP, right? I was saying that I renamed this. Last week it was like the butterfly LP. It turned into stack LP. And then the hammer LP turn was like that double whammy LP, right? But basically what we want to do is we have a bearish range and the spot holding. The reason why you have the spot holding is like you still want upside exposure, right? So maybe you're locking in some losses in case the price do drop by another 50%, 90%. Then in this case, the hammer LP would be better than like, not rebalancing, right? Yeah, like Sal said, you can open a pendle short position, but keep in mind that if you're LPing the ETH pair, you could still be bleeding out in ETH if ETH keeps pushing higher and pendle outperforms, right? And pendle could still theoretically drift up in price, if that makes sense. It's like you still suffer US dollar loss. Yeah, you can still do that. I prefer shorting when prices are strong rather than cheap, because I would rather a lot of my investment, I would rather like ride the drawdown and just wait it out versus like putting in protection when the prices are already cheap. But yeah, it all depends. You could capitulate some of your bag into a bearish LP. Yeah. Yeah. For this case, like Sal said, you could lock it into V pendle as well, or use like the M pendle or E pendle, which are like the liquid V pendles, right? But if you don't have like those options, then you're basically, you could also just hold the spot position, right? That's what I'm doing with the MOG to ETH LP. I did not expect the price to be this weak, but am I going to sell at a cheap valuation? I would personally not, because I don't need the money right now. And it's only a smaller portion of my portfolio, right? And this is how like most of the altcoin pairs should be. Your portfolio ideally should not be like, 90% or 100% altcoins, right? It should be like less than 50% if possible. And if you're overexposed to altcoins, then one of the best way to do so is to sell your fees into like either ETH to Bitcoin or USDC, or just use whatever other income you earn to dollar cost average. Yeah. So yeah, like Sal said, the best course of action sometimes is just to wait it out. If the prices recover, then, you could just, because sometimes the price do dip below like this area of support, right? And we never know if if the support is going to break or not. That's a risk with like investing in general. Like you could look at the historical price action, but the historical price doesn't determine the future, right? Everyone was saying, okay, October, we're going to go up, because historically that October has always been strong, right? But you guys have seen like how weak October was, and maybe, who knows, maybe there's another week or left of price action, but it's always not a good idea to like over index the historical price action, right? And just a note on that is like the crypto market, if you're looking at stuff like Bitcoin dominance, the pattern has only repeated twice, right? So it's not like we have 100-year of price action, and every single 4-year cycle, the price action just followed this same exact pattern. So we never know exactly what's going to happen in the future. We buy assets when we think it's cheap, and then we could take some profits on the way up. But for longer term investing, sometimes it's better to just be like a net buyer than like a net seller, right? In the case of stuff like Bitcoin, sure, you could say like, okay, let me take this swing up and down. But I've heard a lot of stories of people that were in Bitcoin since like 2017. They sold some, earlier on in like 2021, and they never bought back in because they didn't really get the entry that they wanted, right? So there's always a risk of like being sidelined. And that's why, in my opinion, like just like stocks, you want to always have some long exposure, even though you might be riding that 70% drawdown, right? Because maybe 10 years from now, it's going to go up by like 2 to 3x from wherever your entry is, or a higher, right? And then, so let's say you want to do this hammer LP at the bottom of the range. Again, I was saying the hammer LP is better if the prices are strong, because then you can lock in a ton of your profits, right? Let's say you hold a lot of spot bags for Pendle, you ride it all the way up. The best time to enter into this pair is like near the top of the zone, because then you're selling a lot of your Pendle for ETH. And then if the price draw down, you're earning more Pendle in the process, right? So that's a way to stack more Pendle over time. But you could theoretically capitulate a portion of your bag to kind of bet on like the drawdown. So let's say you want to sell some of the Pendle you hold because you're fully into Pendle at the bottom of the range. You keep the upper range at 0.002, and then the bottom range could be all the way at 0, right? And then let's just say the price now from price deposit is now 0.008. Price now drops to, let's just say 0.0005, right? Then whatever portion that you capitulated would have less of a drawdown. You would earn fees in the process. But again, by doing that, you're going to have less upside for this portion of the LP, right? Maybe you put like 50% of whatever remaining capital left inside the LP. So if the prices do recover, you're going to miss out on the upside for that. And then, but the good thing is you would be earning fees throughout this whole process. And it's really hard to tell, okay, like, should you actually capitulate or not? And ideally, it's better not to capitulate if you believe in the assets, and then the assets have solid fundamentals like what Pendle does, right? But the market just has been pretty weak for these altcoins, right? And you guys could compare the performance of your altcoins with other altcoins by simply going to like Pendle, divide by others, right? And then you can see, okay, how good has this altcoin does. But Pendle, I guess, has been doing pretty badly this year so far. I'm not quite sure why the data doesn't load. Yeah. And you could compare like different assets like Pendle to Aave as well. But yeah, it only shows the price action since April or March of this year. So it's not much data to go off of, but you guys could basically see like, okay, sometimes the price would outperform and then underperform over time, right? But yeah, that's basically rebalancing. If you do want to like kind of lock in some losses, you could do that with the bearish LP if you believe the price is going to dip further, right? If the price, for example, if you were providing liquidity for Pendle to USDC, the price kind of lost support, right? Let's say you would have set like a stop loss at $4. If you were trading this pair, then you could be locking in some losses with a portion of your LP. And then the reason why, again, you hold the spot is if the prices do bounce, then you're actually at like close to break even, right? Or at a slight profit if you do decide to lock in some losses. And it's going to kind of like slow the bleeding a bit. And then you could always flip bullish when that happens. But again, when we're doing this, it's kind of like you're trying to kind of predict where the prices are going to go. And if the price do move against you, then you would be losing out on the gains in this scenario. So ideally, that's not something that we want to do, but this is also another option that you guys could consider. Do you guys have any question about rebalancing? But I think that's pretty much it. Like the best way to do it is to actually not have to rebalance. And there's a couple ways that you guys can do that. For example, you could start off wider rather than tighter, but sometimes the price would move out of range still simply because the market would be really weak or whatever. And another setup that you guys could also consider is this stacked LP, right? You have like that bidding LP that is to like maybe zero, right? The lower bound. And this setup, you would at least earn some APR on a portion of your capital. So for this setup, just to go over it really quickly, and let me clear the lines here. But basically, what we want to do is you have this bullish LP, right? And maybe the bullish LP, if you were to enter right now, the lower range could be at either 0.0007, or if you want to add some buffer, 0.006, right? That's the bullish LP. And you could set it as wide or as tight as you want it to, right? If you want more capital gains, you want to go wider rather than tighter. So if you go like max upper range, then the performance would be slightly less good as like spot holdings, but you would be earning APR in the process, right? And then the bidding LP, you could, for example, go to this, and then let's use like red. You're going to have this stacked LP, right? And the best case scenario for this setup is the price just kind of bounce around in this overlapping range, because that's where you would have the most liquidity concentration, right? If you guys kind of look at like the concentration, it's going to look somewhat like this, right? This is the zone where you would be earning the most amount of fees, right? Versus like the top or the bottom. But in this case, the nice thing about it is even if the price goes to zero, you would still be earning fees with this bearish LP, right? So, and the nice thing versus the full range LP is, again, if prices do kind of bounce around in this zone, you're going to be earning more fees than a full range LP. But the downside is if the prices do drop aggressively enough or go up aggressively enough, then one of your pools are not going to be earning money, right? And the really nice thing about this setup is you can adjust the bull and bear ratio, right? So let's say you are kind of conservative, you're not quite sure. Maybe you want to start with like 70% of your capital in this bearish range, and then maybe only 30% in the bull range, right? Or maybe even less, right? Like 80 to 20, because you're more conservative. You don't want to take on that much market risk, but your upside is going to be more limited. Or let's say you start with 50-50. As the price drift up, like what we saw in 2024 or like earlier this year, what you can do is you could compound more of your fees to the bearish LP, right? Because, okay, you believe the prices are going to dry down. Maybe you start with a 50-50 ratio. Then over time, it moves to like, let's say 70-30, right? 70 on the bear near the top range. And this setup is really good if you're trying to actually accumulate this token, because if the price do draw down, you're your drawdown for the bearish LP is going to be much less than the drawdown on the bullish LP, right? And of course, you could sell a portion of your bullish LP back into the bearish LP as well. So that's another setup that you can consider. And you could also add like a tighter range LP, like kind of what Styles had, right? It's still reasonably wide, but not as wide as maybe the bidding or the bull LP for more price, right? And
Richard, is it really that big difference? I mean, having this stacked LP instead of just one large LP, is the APR different?
if you actually look at my Hype to USDT pool, this is currently what I'm doing. Let me share 1 second. So one of the range, right, is 0 to 100. So this is the bear LP. And again, the ideal scenario is a price drift up. So even with the bear LP, I'm sitting in some nice profit, right? And this is the bull LP from $20 to max price. And you can see the difference in price appreciation. The ROI is only about like close to 2% for the bear LP, but it's like 4 to 5% on the max upper range, right? And it's still outperforming holding. And what I want to show here is custom price second. So minimum price is at 0, right? And then max price. Let's say using the same exact data, the custom liquidity concentration, right? And then you're using the same average volume. What we will see is that with the max price, if you drop it to 100, you would see I would gain an additional 5 something percent APR, right? So from like 12 something percent, 12.32 to 17.77. And then what I could do also is the bottom range from 0 to 20, I would also gain about 7% APR in this case. So roughly a 6% net more than like a full range LP, right? So full range, I would get 12%. With this setup, I would get roughly 16, 17%. It doesn't sound like much, but it is a bit more, right?
Okay.
Yeah. And it would scale with the APR as well. So let's say in this case, from 12 to 18 is about like 50% gain, right? So if this pool had like 30% APR, your APR would be jumping by, let's say 50%, then your APR could be around 40, 45%. And again, the nice thing about it is that with the full range LP, there's less flexibility. So if you're bearish on the market, you can't just like add liquidity to the bear side, right? Versus this setup, if you don't want to compound too much to the bullish side because maybe you're a little bit cautious on the market, you could always add much more capital to this bear side and then bid the asset on the drawdown, if that makes sense.
Yeah.
Yeah. So the advantage is not really from like the APR boost. The APR boost is pretty nice. The advantage is more so like, okay, you could directly control like how much you want to compound, how much capital you want to put in for each LP, right? For example, if Hype's price draw down aggressively to like $20, and then maybe you want to like buy a bunch of Hype, but you want to sell on the way up, then you just add capital directly to this full LP, right? Instead of just like buying spot Hype. And then throughout the whole process, you're still earning like 16% APR, which is going to be higher than any like lending or borrowing with like no leverage, right?
Yeah, makes sense. Thanks.
Yep, no problem. But I would caution like using this stacked LP for tokens that you actually don't want to accumulate, right? Because you could still lose money again with any LPs. And this is the best for like the stuff like maybe Hype if you want to take on more risk. But stuff like ETH to USDC, this setup could work really well, right? But yeah, because like a full range ETH to USDC LP would probably earn, less fees as well compared to this type of setup. Yeah, I think that's pretty much it for the rebalancing. But yeah, the main idea, again, just a quick recap, you want to avoid rebalancing if you can. And if you want to widen your range, you could do it at any time. If you want to squeeze your range, ideally it's either very close to your initial entry or when it's above your initial entry. Because if you widen and then you squeeze too early, you're going to be locking in more internal loss. And then you want to make sure you're calculating things before you rebalance. And if you're not sure how to do that, then make sure you, again, rewatch the video or watch like the lessons in like the course. And if you're kind of just like rebalancing without like thinking through things or running the numbers, that's how most people do it. And that's how they get wrecked, right? This is one of the most common way that people lose money when yield farming, aside from like maybe picking assets that bleed out, right? Another thing is like, if you want to widen, you could widen again when you're still in range. That's probably the best time to do it, when you're still in range, rather than, waiting until getting out of range. If you believe that, okay, the price is like much more volatile than I expect, you could always adjust your range at any time. What you have to track again is your initial entry. And you could also track like what you deposited initially to make sure that you're not bleeding out money, right? But yeah, that's pretty much it, guys. Unless you guys have any question, we could call it for now.
I have none. So thank you, Richard.
All right, no problem. Thanks, Styles. Thanks, Austin. Thank you. Thanks for joining. I'll see you guys on the
See ya.
next one. See you guys later.